Hi, good morning, good evening, wherever you are. Welcome back to the Tummy Investor channel. As some of you might know, I've been, I would say, now relatively a long-term do-it-yourself retail investor in the stock market, equity markets, and I started this channel to periodically share my personal experiences and experiences of investing in the markets, which hopefully can benefit other retail investors. Now, coming to this specific episode, I usually don't like to discuss specific companies and stocks. However, given the nature of the world we are in right now and how a lot of liquidity is chasing very few potentially high quality assets, the IPO of Burger King India, which is supposed to start on December 2nd and will go until December 4th, has generated quite a lot of interest. And my specific intention of creating this episode was to just keep it very crisp and precise and really evaluate whether it makes sense to go for the IPO or even, on a grander scheme of things, whether it makes sense to hold Burger King as a part of any investor's core portfolio. Now, before proceeding ahead, please do, as a disclaimer, understand that these are my views and I could be biased. And Investing requires your hard-earned wealth being invested, so please use your own discretion and don't take anything I say at face value. So let's just proceed ahead. Now, the first question to ask is whether the Burger King India stock through the IPO is a fit for all investors or not. And the answer, like any other IPO or any other company that you want to consider including as a part of your portfolio, is that it's not for everyone. And I'm going to come down later on in terms of looking at both sides of the coin in terms of why it makes sense to hold it and why it probably doesn't make sense to hold it and leave the decision to you. But um clearly, there's tons of information out there on the IPO. It has been discussed a lot. It's generating a lot of eyeballs, buzz all over the place, which sort of indicates where the market is right now. Um, so these are just my perspectives. So let's just go ahead. Now, let's just go through some hygiene information in terms of what are we looking at. Now, Burger King India operates um, under what we call as a quick service restaurant, quick dining restaurant kind of a space. Typically, these would comprise of very reputed brands like McDonald's, Domino's, Pizza Hut, KFC, Taco Bell, Subway, and so there's a lot of brands out there which are playing, and quite a few of them are present in India as well. The one thing to understand about this entity that is coming up for IPO is that it's called Burger King India. However, it is owned primarily by a private equity player called Everstone Capital, which is based out of Singapore. Now, Burger King Global worldwide was acquired by another private equity firm called 3G Capital. And clearly, the parent company called out expanding into India as one of its strategic priorities because that's where the consumption and the growth is. And they, in turn, um, sort of took on the services of Everstone Capital to help them develop the business in India. So Everstone currently, to my knowledge, holds more than at least 95% stake in the entity. I mean, they've sold a few, offload a part of the stake to other P players and some preferential allotment, but easily it is 90% plus. And then they are obviously looking to partly offload their stake as a part of this IPO. Now, the reason why this IPO is happening is because Burger King India has a master services franchise agreement with Burger King Global to develop and grow the business in India, and they need funds to expand their presence. Clearly, they've been given a they were initially given a target of expanding quite aggressively to 700 stores by 2025. However, because of the COVID situation, that deadline has been extended by a year. So we are currently looking at an expansion plan of 700 stores by 2026, potentially, from a current base of 261 odd stores. Now, it, Burger King India, like I said, operates in a space of quick service restaurants, which has been, at least in India, entrenched by some of the other brands that you would have seen. Domino's operated through Jubilant Foodworks, McDonald's partly operated through Westlife Development, and then KFC operated through Yum Brands, which is private. And all of them already have got a head start into the market. Domino's and McDonald's came in back in the mid 90s. Um, Yum Brands came in the early part of 2000, 2004, and so they've clearly got a head start. However, Burger King India has been expanding aggressively and currently has a 5% market share approximately in the space that is defined in that QSR category. Domino's, of course, leads by 21% market share, followed by McDonald's at 11% and KFC by 10%. Now, I do want to call out one point that although they operate in the same space, the business models are very different. And you would have seen it firsthand. Domino's is more focused on, delivery network because of the kind of food that they prepare, which is pizza, which is very uh, sort of friendly to a delivery network. Whereas obviously McDonald's and KFC and Burger King rely a lot on casual dining through their stores, but also, because of the COVID situation and because of the way generally e-commerce is progressing, they've also started expanding their delivery network. Now, the other point to, of course, note is that even geographically, these players are present or dominant in different parts of India. For example, Burger King is predominantly present in North India, close to 50% of its stores, whereas McDonald's is focused more on West India, and Yum Brands is focused, or KFC is focused more on South India, just in terms of the mix. Um, East India is only predominantly addressed by KFC in terms of a sizable percentage exposure, but clearly all three of them operate in North, West, and South India. Um, Now, the other consideration is that, of course, Burger King India is not profitable. It hasn't been profitable, and just in comparison to some of the other players, Jubilant Foodworks has been consistently reporting profits for the past 10 years, except for 1 year. Westlife Development, which operates McDonald's, has been inconsistently profitable. So clearly, this space is highly competitive. There are a lot of inherent costs in the business. This cost of managing the physical stores. Now, cost of delivery is also increasing. In addition, all of these entities need to pay, roughly 2.5 to 5% of their sales as royalty to the parent entity. And so Burger King is no exception. However, the company stated that while it is not reporting positive earnings as per accounting standards, it is cash surplus. So that's just a brief summary of just the lay of the land in terms of what we are looking at. Now I'm going to just spend the next half of this on when does it make sense and when does it not make sense. Now, clearly, investors who are more consumption story focused, India consumption story focused, will find this listing to be of great interest. Um, it's a strong franchise, it's a strong brand, it's being obviously there is a strong global entity which is giving it cover, which will bring in best practices and knowledge sharing. So, in that sense, it is an important factor to consider. The other trend to keep in mind is, of course, this whole migration from the unorganized to the organized sector as far as casual dining is concerned. Although um, I have my neutral reservations on it because not all Indians like to eat fast food, or at least the Western um, world version of fast food, right? So it is, but it's obviously very popular with the younger generation, and what essentially what investors who would want to consider this stock would be relying on the huge growth potential that exists going forward. Now, all uh, um, they have clearly stated out their store expansion plans, so there is some indication of the runway ahead for the next 5 years. We are looking at an expansion of the current 261 stores to 700 odd stores. And the idea is that with efficiencies, with greater understanding of the Indian market, they'll start reporting profit. They were close to reporting profit last year. However, this year, um, the finances have really taken a hit. Revenues are down by 65%. Profits have, you know, sorry, losses have increased 4 times. So that is some important data points to keep in mind. Now, so, in a nutshell, you should only consider this company if you feel you need a good, strong consumer brand oriented franchise as a part of your long term portfolio and you're betting on the India growth consumption story. Now, when does it not make sense? And this is probably resonate more with true value investors. Um, it's already trading at a 40% premium in the gray market. Again, I don't have qualified sources for it, but that seems to be the case. The entity is not profitable, and if you're going to take the trend of Westlife Development, where they've been very inconsistent in their profitability, looks like because they operate in similar burger market, the trend will continue for Burger King as well. The other thing is, of course, it is private equity owned in terms of Everstone, and private equity players usually have a defined window where they want to exit from the business. So it's which might mean that the entity will focus on growth at any cost, and they'll just focus on the top line expansion without really necessarily worrying about reporting sustainable profits. The other question in consideration is what will happen once Everstone exits. Does the global entity take over the India arm, or is it acquired by somebody else? That's another consideration, but not an immediate decision point, of course. Now, the more important thing is, of course, valuations. Now, it's roughly a 2,200 odd crore market cap company, close to, I mean, if I were to take uh, their last year's revenue, it was 846, assuming it comes down to half. We are looking at roughly 450 crores market cap, and so it'll put it in the range of 5 to 7x multiple, or maybe 4 to 5x multiple, depending on how FY21 pans out, which is comparable to some of the other guys that are already listed. However, like I mentioned, Jubilant seems to be the only one who's figured out how to make this model profitable, and you can see that reflected in the stock performance. 27% CAGR over the last 5 years, whereas Westlife, which has been very patchy in its performance, has only done 12% CAGR despite all the limelight that some of these brand powerhouses get. So net, uh, investors who see consumption story, big brands expanding into India should consider this IPO. People, but you know, success in business doesn't mean success in investing. And that's one thing to remember, and that will be as demonstrated by the Westlife, returns in the last 5 years. And so, value investors might want to just see whether it makes sense and whether they are overpaying for this IPO, and take a decision accordingly. So that was my just short, quick takeaway on the Burger King IPO. I hope you found it useful. Please do subscribe to the channel and like the button if you like the video. Thank you so much and have a great day.